Large technology companies naturally push against the outer boundaries of what the law technically allows, while regulators are meant to keep them operating inside those limits. The problem is that there is vastly more money to be made just beyond the strict wording of the law. Over time, these companies have perfected reliable methods for slipping past legal constraints and unlocking markets that few people even realize could exist. Uber sidestepped taxi regulations. Food delivery platforms found ways around minimum wage rules. Buy now, pay later services stretched consumer lending standards to their limits. Airbnb maneuvered around hotel licensing and zoning requirements. Crowdfunding platforms worked around traditional investment regulations. Then there are even clearer cases, like bet on anything platforms, that quietly bypass gambling laws and age restrictions using paper-thin financial technicalities. And that still doesn't begin to address the complete regulatory chaos that has been tolerated in the gray zones of cryptocurrency. What's striking is that every one of these companies that boldly stepped into areas the law tried to block is now valued in the billions. In the ongoing clash between technology and regulation, technology has been winning almost every time. In the short run, tearing down rigid systems can genuinely benefit workers and consumers alike. But when companies are willing to bend the rules to win public support at the start, it creates a dangerous precedent once they dominate a market. That's exactly the situation we're in today. In theory, the fix is straightforward. Strong, well-funded regulators with enough staff to enforce the letter of the law from the very beginning. But let's be realistic. Everyone knows that kind of regulatory response isn't arriving anytime soon. So instead, the most useful way to understand this dynamic is to walk through the process step by step. That way, if someone wanted to build a billion-dollar tech platform by exploiting the wording of the law, they would at least have a proven playbook to follow. Now, this strategy itself isn't actually new. It's known as regulatory arbitrage, and opportunistic businesses have used it for as long as rules have existed. The basic idea is simple. If you can identify a loophole or gray area in legal language, you can launch a product that's far more competitive than rivals who stick to the spirit rather than the letter of the law. The term gained traction in the 1980s during the introduction of the Basel Accords, which aimed to establish shared standards for the global banking system. Banks operating under different central banks faced different capital requirements. In plain terms, this meant they were required to keep varying amounts of customer deposits on hand instead of lending them out. Some countries required banks to hold just 5% in reserve, while others demanded as much as 25%. Banks with higher reserve requirements were more stable, but because they couldn't lend or invest as much capital, they struggled to offer competitive interest rates and naturally earned lower profits. They soon realized that by operating in jurisdictions with the loosest rules, they could exploit these differences and gain an edge over banks playing by stricter standards. Ironically, Basel I, followed later by Basel II and Basel III, were international attempts to stop exactly this behavior. Yet much of the financial system responded to these rules by leaning even harder into regulatory arbitrage. One common tactic was setting up mortgage originators, or non-bank lenders, that were funded, promoted, and effectively run by banks, but were technically separate entities. This structure allowed banks to issue far more mortgages with the same amount of capital than regulations would normally permit. And, as history has shown, that worked out incredibly well, until it didn't. Today, this game of finding loopholes before regulators can close them has become both easier and more profitable than ever. So if you want to participate in this strategy, the first step is to target an industry weighed down by heavy regulations that make it unpleasant to deal with. For our hypothetical company, let's aim at education. People are generally unhappy with the school system, but competing directly is difficult because there are extensive rules governing how these institutions must operate. Those rules add extra costs, complexity, and rigidity, burdens you won't have to deal with if you successfully execute the rest of this plan. The goal is to create a cloud-based, decentralized, gig-style education system where freelance teachers earn commissions by running classes. The next move is to identify a non-commercial version of the industry that's just similar enough to provide the classic, don't worry about it, legal justification. For Uber, the argument was, don't worry about it. These aren't unlicensed taxis. They're just people sharing rides. For Airbnb, it was, don't worry about it. These aren't illegal hotels ignoring zoning and licensing laws. They're simply strangers who met online and decided to become extremely short-term roommates. For buy now, pay later services, you already know the line. Don't worry about it. These aren't unregulated, predatory loans issued without proper licenses. They're just digital versions of store layaway. For you and your shiny new platform, let's give it an unbearable name like Schooly. You'd go with something like this. Don't worry about it. This isn't an unregistered school staffed by unqualified teachers. It's a cooperative network that allows parents to share the workload of homeschooling with small fees to cover the cost of organizing classes. This argument won't hold forever, but it doesn't need to. Modern network-based technology is the secret ingredient that turns this shaky justification into a multi-billion-dollar challenger to slow, inefficient incumbents. So now it's time to understand how this works and why these technologies seem to win every single time. This week's video is sponsored by Odoo. Whether you've ever considered launching a new business or improving one you already run, Odoo is an all-in-one business management platform offering a full suite of integrated apps. It helps small and medium-sized businesses manage sales, accounting, inventory, manufacturing, and much more, all from a single system. What really sets Odoo apart is its flexibility. You only install the apps you actually need, and everything connects smoothly, from CRM and sales to inventory and production, keeping your business organized as it scales. We use Odoo ourselves. Our How Many Works library runs entirely on Odoo, and having everything inside one platform makes operations far easier to manage without bouncing between different tools. It's also intuitive and highly customizable, which makes it ideal for businesses that want software to adapt to how they work, not the other way around. If you want to see how Odoo can streamline your operations, you can try it free for 15 days with no credit card required, and even keep one app free. You can check it out using the link in the description. All right, step 3 is making sure your regulatory loophole is powered by technology wherever possible, and there are 3 key reasons this matters. The first is that technology, especially user-driven networks, can scale far faster than trying to run the entire operation yourself. Once you start exploiting a legal gray area, the countdown begins. Eventually, regulators catch up, or lawmakers simply close the loophole. Sure, these groups aren't exactly known for moving quickly, especially if a few campaign donations help slow things down. But in this game, they're like that infamous killer snail. Get comfortable for too long, and eventually they catch you. If you had to personally build every decentralized school, hire every teaching consultant, and onboard every student by hand, you'd never make it far enough before legal trouble shut everything down. Technology-enabled networks solve this by letting you build a system where everyone else does the hard work at scale, allowing you to move much faster. The second advantage of focusing on technology is cost. Over time, it's significantly cheaper. Let someone else deal with maintaining their so-called taxi, hotel, or school. Your role is simply to act as the convenient middleman. The third benefit is that scalable technology is far more attractive to venture capitalists willing to place massive bets. Building and operating your own school requires huge upfront investment that may never pay back. Even if you manage to run a profitable business in such a niche market, those returns arrive slowly. By contrast, putting the same amount of money into a platform that enables others to build schools can scale as fast as servers can onboard new users. That means the possibility of 1,000 times returns is much higher, something venture capitalists care deeply about, since those rare wins are meant to offset the losses from the 999 similar startups that didn't survive. Once you've identified your loophole and raised the capital to build technology that can exploit it quickly and efficiently, it's time for step 4. Launching the product. The key here is being extremely strategic about where that launch happens. Some cities, states, and countries are far more relaxed about this kind of activity than others. You want to shop around for a government that is least likely to come after you during that initial rollout. Historically, places like Silicon Valley or Austin have been popular because they tend to be friendly toward new technology. But these days, it's smart to think beyond the usual options and even look internationally. For Schooly, The ideal starting point is probably a smaller city with a dysfunctional school board, poor student performance, and a state government that's already comfortable with homeschooling and charter-style education. After you've chosen one or several launch locations, step 5 is to do whatever it takes to make those early rollouts look like overwhelming successes for everyone involved, except for now your shareholders. That means aggressively spending investor money to heavily subsidize services, paying gig-based teachers far more than they'd earn in traditional schools, and making sure the broader community feels positively about your presence. Sponsor local sports teams, donate to charities, and loudly promote all the bureaucratic inefficiencies you're eliminating. The taxpayer dollars you're saving, and how amazing it is that Nowheresville, West Mississauga, is outpacing major cities by embracing the future. Checking all of these boxes will almost certainly cost a lot of money. But in reality, this spending is just a marketing expense designed to buy political leverage for later. Because step 6 is to repeat the exact same playbook everywhere. The strategy is simple. Rank cities from weakest to strongest regulatory oversight and move through them as fast as possible. Some jurisdictions will push back, but ideally by this stage, you've raised enough capital to keep underfunded, understaffed local regulators tied up in court for years before it becomes a serious threat. Meanwhile, you continue adding users and contractors every single day. Step 7 is to become too big to punish. If the scaling has worked, by the time the legal system makes any real progress, you'll be serving millions of users and independently enabling business opportunities for hundreds of thousands of contractors. Uber, for example, is effectively one of the largest employers on the planet, even though it technically doesn't employ its drivers. At that point, even a decisive court ruling that you clearly violated regulations by operating unregistered taxis would come too late. Politicians simply won't tolerate having that many people suddenly classified as unemployed on their watch. If Schoolie can offer similar opportunities to its homeschooling specialists while sprinkling in a healthy dose of, "Won't someone please think of the children?" then once the platform reaches sufficient scale, it becomes extremely unlikely that any politician will have the nerve to take it on. With all these pieces in place, you can then go ahead and shitify the platform, tighten margins, and start repaying the investors who funded the whole journey. In fact, many early-stage venture capitalists will actively help guide you through this checklist because they've done it countless times and know it gives them the best chance of seeing their money again. It all sounds pretty ugly, right? But just to complicate things, there's another side to this story. Sometimes this entire process is actually what a market needs. The flip side of regulatory arbitrage is regulatory capture, and in many cases that can be even more harmful. Regulatory capture happens when entrenched companies deliberately pile on layers of red tape that are nearly impossible for new competitors to navigate, and in extreme situations, effectively ban competition altogether. As one example, internet companies have seriously argued that the First Amendment gives them the right not to share markets with competitors, which goes a long way toward explaining why your internet experience is probably so terrible. The famously cynical old guard over at Micro made an excellent video explaining this dynamic, and it's genuinely worth checking out. Watch that next to understand how something like this is even possible. And don't forget to like and subscribe if you want to keep learning how money really works. If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.